All right, what do you have to know for the CPA FAR exam on the statement of cash flows prepared under the indirect method? The indirect method starts with net income, the bottom line on the income statement. All items of revenue, expenses, gains, and losses, and we get net income. We start with that under the indirect method, and then we adjust because what we want is the cash generated from the core business. So the indirect method ends up being a reconciliation of net income to cash flows from operations. So we're going to start with net income, but then we're going to do things like add back certain items, subtract other things. And I don't want you to memorize, I want you to understand why. For example, we're going to add back depreciation expense. Why? Because it's a non-cash expense. Remember, we're starting with net income and we want the cash flow statement. Particularly, we want the cash flows from operations. So if we're starting with net income has already subtracted depreciation expense to arrive at net income. Depreciation expense makes net income go down. But since depreciation is a non-cash expense, it gets added back to net income under the indirect method. Here's an example. If net income were $100,000 and depreciation expense of $10,000 was subtracted on the income statement to arrive at $100,000 of net income, then add back the depreciation expense because it did not involve a cash outflow, and we want net cash from operations. So why do we add back depreciation expense? Because it's a non-cash expense. Will we always add back depreciation? Yes. Under the indirect method, we'll always add back depreciation. What about under the direct method? Would we add back depreciation? No, because under the direct method, we don't start with net income. All right, what else gets added back to net income under the indirect method? Bond discount amortization. Why? Because bond discount amortization makes interest expense higher. And therefore, as interest expense goes up, net income goes down. Bond discount amortization reduces net income, but it's a non-cash expense. So the amount of bond discount amortization gets added back to net income under the indirect method. Here's an example. Let's say bonds are sold for a discount at $980 when the par value is $1,000. So you got to pay back $1,000, but we're only getting $980 today. So there's a discount of $20, and that discount is being amortized $2 a year. The cash paid for interest is $10, but notice as we amortize that discount, that makes interest expense go higher. Because when bonds are sold at a discount, interest expense is always higher than the cash interest paid. So on the income statement, we subtracted 12 for interest expense. But now on the cash flow statement, we only want the cash paid, which is 10. The difference of 2 made net income go down. So that's why we're going to add back that 2. So add back the amortization of the bond discount to net income to arrive at cash flows from operations. And you might be wondering, what if this was a bond premium? Would it be the opposite effect? Yes, it would. Let's try this question. Which of the following gets added back to net income under the indirect method? Depreciation expense, do we add that back? Yes, because it's a non-cash expense. Amortization of a bond discount, do we add that back? Yes, for the same reason, it's a non-cash expense. So both are correct. The answer is C. Notice that when bonds are sold at a discount, the amortization of the bond discount increases interest expense. Thus, that increase in interest expense by $2 we saw reduces net income by a non-cash amount. So this non-cash amount, $2 in our example, got added back to net income to calculate cash flow from operations. This would only happen under the indirect method. Would we add it back under the direct method? No, because we don't start with net income. Only under the indirect method would we add back depreciation expense and amortization of the bond discount. How about this one? During the current year, ACE Company amortized the bond discount. ACE prepares its statement of cash flows using the indirect method. In which section of the statement should ACE report the amortization of the bond discount? and it would be in the operating activities section. We'd add it back to net income. So the answer is B. The amortization of a bond discount is added to net income in the operating section of the statement of cash flows prepared under the indirect method. What about a bond premium? Here's an example. So if bonds are sold at a premium, they're sold above par. So this bond is sold for $10.20 and the company has to pay back $1,000. So they're getting $20 more. They're getting a premium. When you go to amortize the premium, let's say it's over 10 years. So $2 per year is amortized. The cash paid is 10, but the interest expense would actually be less than 10. Why? Because when we amortize the bond premium, we debit the premium, and that's a reduction of interest expense. So the cash is 10, and I'm just making that up. It doesn't tell us the interest rate or anything. Just believe me, let's say that cash is 10, but the interest expense would be less than 10 because you're amortizing the premium $2 a year, and that reduces interest expense. So what you end up with is interest expense lower than the amount of cash paid. So the income statement will show only $8 in interest expense, but you want $10 on the cash flow statement. So you're going to have to do what? Well, since interest expense is only 8 and not 10, the income statement will have $2 more in net income because the interest expense is 8. So what you're going to have to do is subtract another 2 from net income so that you can equal the cash outflow of 10. Let's try this one. A company has net income of $100,000. They amortized a bond premium of $3,000 during the year and had depreciation expense of $2,000. How much cash is provided by operations in the current year under the indirect method? So you'd start with the $100,000 net income, and of course you would add back the depreciation expense because you always would add back a non-cash expense like depreciation. So it looks like 102 so far. But then you would subtract 3,000, the amortization of the bond premium, and you would get 99,000. And that's choice B. Now, why did we subtract the amortization of the bond premium? When bonds are sold at a premium, interest expense is lower than cash paid. Lower interest expense makes net income higher, in this case by 3,000. Since net income is $3,000 higher, we're going to have to subtract the 3,000. All right, let's try one with a bond discount now. Company has net income of $100,000. They amortized the bond discount of $5,000 during the year and had depreciation expense of $2,000. How much cash is provided by operations in the current year under the indirect method? And if you think you know the answer, leave it in the comments section below. And then don't forget to like and subscribe because it helps the channel out a lot. And if you found this statement of cash flows video helpful, go to CPAexamtutoring.com and get yourself on I-75, the right road to passing FAR. I'm Darius Clark, and the right teacher makes all the difference.